Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today has been a real estate investor since 2005 with a portfolio worth over $15 million. He's been involved in the development of single-family homes, multifamily, historic renos, and land development. Mike Nuss is co-founder of Rare Bird. Mike, welcome to Purchase to Profits. It's great to have you on the show.
Hi, Seth. Thanks for having me. Pleasure to be here.
I'm really looking forward to this. You're a guy who has many different companies all under your umbrella, so you'll have some interesting stories to talk to us about.
I hope, yeah.
Yeah. So to kick things off, do you want to share your real estate goals right now? Like, what are they?
Yeah, that's a good question. So I kind of have multiple real estate goals right now. One of them is just kind of at the company level. What can we do as our brand, our various service companies, and impact our community, other investors in the area. So there's kind of that level just from our service companies. We've been putting a lot of effort into that. From the real estate investing level, kind of short term, because market conditions have changed, we've slowed down our acquisition a little bit on the multifamily hold process. So kind of getting close to wrapping up. All we buy is value add, and that is just a big lift to get projects finished and going. And so just two more projects to finish. One of them's actually done, just need to finish leasing up. And then the other one's new construction. We have a GC on. So getting that portfolio fully repositioned and then actually starting to live off some of that income. Looking forward to that. The next phase for us is really kind of twofold in the syndication world. We've been really historically hyper-local just in Portland, central Portland, close to the city center, and that's been really well for us. But with market conditions changing and kind of some of our bigger goals, syndications on the platform, and we really want to do it in two formats. One of them is outside of the Portland market. So for the first time ever venturing into other markets, doing some larger deals. It's just Portland's not a cash flow market, and it's harder to acquire larger amounts of money from the cash flow here. So it's a wealth building place, not a cash flow place. So we'll look at some other markets for the syndication on that level. And then we do want to do some syndicating with affordable housing, low income housing in mind here locally as well. So those are kind of the two next phases and goals for us is how do we up that syndication level.
Yeah. And you're a guy with lots of stuff on the go. So do you have any maybe routines that you follow or rituals that helps you stay focused on all those separate goals?
Yeah. I historically have not been. I read Miracle Morning in 2015. That kind of changed my life a little bit. But staying consistent with that's been really difficult. In October, November, I actually joined GoBundance. I don't know if you've heard of that group, but that's an accountability that's really done a lot. So now I do have a set morning routine and a set evening routine. Every morning, meditation, journaling, exercise, affirmations, gratefulness, thankfulness. So I go over that every single morning. My goals, I need to start. I've never been really a goal guy. I'm kind of more of in the forest rather than looking at the trees scenario. So I really need to hone in and do that goal portion. But no, I found getting a morning routine and a night routine and journaling too. I'm in a 28-day challenge with the GoBundance guys on their journaling, and that's been huge. And just getting those thoughts out. But I definitely need to write down my goals a lot more to get that focus going.
Yeah. And I'm curious, like, how does your mindset shift from when you first started building up your companies to now that you're going after the bigger fish? Like, what changes have to occur in your mind to do that?
Yeah, that's a great question. Early on for me, when I was an appraiser, I was an appraiser for 20 years. It took me 10 years before I realized that I should be buying real estate and owning real estate just rather than appraising it. So I've been slow to the game. I think initially when I got into investing, the focus was how do I make my first million? How do I get to that level? I actually became a millionaire relatively early on, mid-20s, market crashed, and I was bankrupt 6 years later. So kind of focusing when I met my current business partner in 2010, we were just focused on ourselves and we didn't have the service companies. And so getting to that first million mark, that was a big deal. I remember getting in debt the first $1 million in debt, and then it was $5 million in debt, and it's $10 million in debt. I think now, though, the focus is how many other millionaires can we make, right? So what's the impact we can do for others? And if we help enough other people become millionaires, what does that do to our lives? And specifically, my business partner and I have been having conversations about how do we make our employees millionaires. And I think that just elevates the game. If we start focusing on other people and their goals and helping them accomplish those, that's going to skyrocket our success. So I think that's kind of the mindset shift where I'm in right now.
Yeah, no, 100%. You mentioned that, your bankruptcy. Do you want to, without turning up any bad feelings from back in the day, do you want to explain, what that was like and how you actually rebounded and built back up again?
Yeah, it's funny. So, I bought my first piece of real estate in 2003, and then some more rentals in 2005. And early on, as an appraiser, who were my friends? They were brokers, mortgage brokers and real estate brokers. And, they kind of spread that myth of you don't need to make cash flow on real estate. It's okay if you're negative $100 a month. When you do your tax return, you're fine. The reality of cash flow is when you have 5 properties go vacant at the same time, it takes 2 months to lease those up, and then you rent them up at a rate lower than what you had. That puts a significant strain on your income. So when the market crashed, not only did my real estate crash, but my income, because I was an appraiser, crashed by 80% as well. So I just wasn't really well prepared for the market. I started having to do some short sales, and I actually made it through that fine. What got me bankrupt, and this is a lesson for all your listeners, is choosing the wrong partners. I got into the wrong partnership. So the first partnership I got into when I transitioned away from appraisals and into investing full time, it just wasn't a good partnership. So 2 guys ran the company. There were others around kind of bringing talents to the table with the promise of getting paid out of profits. And then profits never realized because the 2 guys bought cars and clothes and all that. So it was really just a bad business partnership that got me, that ultimately led to bankruptcy. So, and then to answer that question, how did I focus on rebuilding after that? And that's the exact answer: is you don't fix the past, you move forward in the future, right? It's a lot easier to just move forward and build what you can to make up for the past than it is trying to rectify anything. So at that time, so 2009 is when I transitioned full-time into investing. 2011 is when I went bankrupt. So I had a ton of skills at that point. I've been acquiring a ton of real estate through this partnership. So the acquisition skills were there, project management was there, property management was there, valuation was obviously there. So I had the skills in place. And so moving forward, I just needed to focus on putting those skills into place.
Yeah, actually, I'm sure a lot of people will have a hard time believing you have 20 years of experience in appraisals. You look like you're mid-30s.
Yeah, I shaved last week, so I don't have as much facial hair. That happens.
Yeah. And, you mentioned you got involved with the wrong partners. How do you vet partners now to make sure you don't end up in that situation again?
Yeah, a deal by deal scenario. So I have one business partner that I'm partnered on everything on, all of our service companies, all of our rentals. And then from there, we have 3 other small partnerships on just rental holdings. So right now, if we do a partnership, it's not at a business level. It's at just an individual property ownership level. We make sure we have control in that transaction from a managing member standpoint. And if we do looking to get into longer term partnerships, we were looking at trying to partner with a construction company last year. We really focus on incremental steps and kind of structure things so there's a practice time, right? A testing out period of time. There's no legitimate marriages happening unless it's at the real estate level and we're all bringing complementary skills or assets to the game. So and the other part is you got to trust your gut. Like, going back to these 2 guys, I knew from the get-go I had these gut feelings that I just didn't trust, and I guess I wasn't in tune at that point. You just learn from that. So your gut matters. And the other thing is the partnership has to be more about money, more than money. If it's just about money, that's just so easy to fall apart. All it takes is one squirrel, one more profitable scenario pulling one head in a different direction. So there has to be something there more than just money.
Yeah. Do you want to maybe elaborate a bit on what those other things would be besides the money?
Yeah. Well, are you at a cash flow level, or are you a long-term wealth building level? In the Portland market, we can't partner with anyone who's just looking for cash flow, because that's not what this market is. We have some great cash flowing properties, but we're in a wealth building market. So when you look at the appetite of our partners that we partnered in real estate in, it's long-term ownership, right? We're looking at a 10 plus year window. In our partnerships, we're bringing the real estate skills. Our partners are bringing the cash portion of it. When it comes down to the business level, it's who's bringing what, who's bringing a business development, who's bringing a marketing, who's bringing an implementer, who's bringing the visionary role. So it's, we all have our skill sets, and if they don't overlap, that's where the synchronicity is created, is in that overlap. So you look at my business partner, he's not really a real estate guy. He knows real estate, he can teach real estate, but that's not his background. I'm not really an entrepreneur. I hate structures, I hate systems. So I'm the real estate guy, he's the business guy. And so we have some really good complementing skill sets in that role. And our employees know who to talk to about various things because of the hats that we wear. So I think that's what you're looking for, is complementary skill sets.
For sure. And so what sort of systems are you either changing or implementing that's going to allow you to scale up with that multifamily?
Yeah, great question. I'm embarrassed to say, but I've never managed a CRM ever. It's always been Google spreadsheets in my brain. Now our business is getting big enough, I can't remember everything. So we're implementing a CRM. That's been a big push for us, because we have a brokerage we want to get a CRM set up for. We have our acquisitions we want to get a CRM set up for. And then we have our investor community that we want to get our CRM set up for. So that's been tough to find the right one. But that will be huge for us. A big change for us was implementing Asana for task management from a company standpoint. So we use Asana for both communication and task management. And with the various companies, we only have 4 full-time employees, so we're all wearing multiple hats. So that's been huge for us from a communication and task management standpoint. Other systems, again, I'm not the systems guy. Those are the only 2 that I can think of right now. So that's kind of where we're at in the changes there.
Yeah, for sure. So out of all the deals you've done so far, is there one that stands out as a Keystone deal that made a big impact for you and your business?
Yeah. There's, 2 that I was thinking about. One was our office that we purchased here. That was kind of a couple years ago, kicking us off to level. But really kind of the one I'd like to go into is the first multifamily property that I purchased with my partner in a partnership. So this was the seller finance deal back in late 2011, early 2012, I think, is when we actually finalized the deal. But essentially we were able to buy, you just want stats on that? You want me to kind of go into the deal now?
Yeah, let's go into the story. So how'd you source it, first of all?
Yeah. So this was actually a newer investor, Bird Dog, right? So they didn't understand the tools. They built some rapport with the property owner from the get-go, a couple that we had known for a while, and we're kind of just giving them some mentoring to, found this property owner, met with them once, kind of got the idea of what that property owner was trying to get out of the transaction. But they also knew that they didn't have the resources, even though when we get into the resources, it didn't take much. Yeah. But I think it was the confidence they didn't have. So they essentially said, hey, we have this property. Here's kind of some gross terms that we're talking about. Overall, would you be willing to pay us, a finder's fee for this transaction? And at that time, we didn't have any really licensing that we needed to worry about. And so, and I think we paid him like $10,000. So that's what it was, is we committed on paper before actually meeting the property owner, we'll pay you $10,000. And that was signed on a non-disclosure agreement if we successfully close on the acquisition of this property. So that's how we sourced it.
Yeah. And so what, when you first heard about the property, what jumped off the page at you saying, I have to buy this property?
It was really the seller's desire for the seller financing portion of it.
Okay.
Yeah, the property in itself is a junker. It was a triplex. It was good size units, townhouse style units, but part of a town. It was in a part of town we never invested in. Tenant class wasn't great. The neighborhood level wasn't great. There is definitely some upside in it. There's deferred maintenance. And the terms of the deal were good. So in Portland, you can't get the 1% rule. It's just very difficult to get the 1% rule. This actually had the 1% rule going for it. So the numbers made sense from a cash flow standpoint, but it was really the seller piece, the mindset of the seller, that just really brought us into it.
Yeah. So I guess the message there, I'm going to assume the seller was in a pretty motivated position to move that property.
Yeah. He bought it new 40 years prior, 35 plus years prior. So a ton of appreciation, obviously, fully depreciated the property. He's looking at capital gains. He had actually occupied it at one point. The deferred maintenance was more due because he was the fix-it guy. He's the handyman guy, kind of your millionaire next door type. I hate that book, by the way. But that type of mindset, right, where he's all about saving money, not spending money. So because of the capital gains, and again, he didn't need cash either, right? So he's a well-off individual. He was more focused on not paying taxes. And that's kind of the demographic we love to negotiate with. So at that point, it was just, okay, well, what works for you? What works for us, that will work for you. And we kind of just went from there.
Gotcha. And so how did your partner factor in here? Because you said this is the first one you purchased with your partner. Like, was your partner bringing in the capital? Like, how did that work?
We were already in a full-blown partnership at that point.
Okay.
So, I mean, we already had shared bank accounts or business bank accounts and stuff like going with that in agreement. So this one, we knew we were going to be buying together. It was just a matter of everything at that point had been in our S Corp, which is our flipping entity, our short-term project entity. So at that point, it was just creating our first LLC for a rental pool. And then as far as that, it was we were bringing the capital as a business. And it didn't take much capital. We had that capital in our development company already. So it was just more, this is the next phase of where we want to go with our partnership and implementing that.
Gotcha. And actually, maybe we can back up a little bit. Somebody might be watching and wondering how they might go about approaching a seller to, carry the financing, doing the seller financing. Do you want to explain, how you would go and approach a seller?
Yeah. So everything we buy is direct face-to-face with the property owner. And I know a lot of people that are successful doing it otherwise. For me, that's what's worked well for us, is just building that rapport first off. So for us, you just start as a listener. So one of our core values is listeners. We're listeners, agenda-free listening. So, and that's the beauty of having lots of skills. So anyone who focuses on one skill set in real estate, I think, is missing the boat. When I go meet with a property owner, it's literally, I have lots of tools to use here, but first let's have a conversation before we even start talking about these tools. Because half of them we're not even going to even consider. Of those remaining half, 10% of them might come out, and then maybe you use one of them. So I just start with the conversation and listening. The biggest question that I've asked that just has made me the most money out of anything is, what are you going to do with the money? And when you're working with the right demographic, if you look at the typical property owner for us, it's absentee owners. So they own a rental property. They've owned it for decades. So they have no depreciation left. They have a ton of appreciation. They're looking at 6-figure capital gains tax bills. And so seller financing just makes a ton of sense for them. We know that going in, but I never push that agenda. Again, it's agenda-free listening, right? So that question kind of spurs it. What are you going to do with the money? And when they start talking about putting it in the bank, that just opens up the door for the other conversation. And when you're working with that demographic, seller financing was a huge tool back before, the modern lending age really came in the 70s and 80s. And so for these people that were living in the 50s, 60s and investing, buying real estate at that point in time, they understand a land sale contract. They understand seller financing. They understand how to avoid paying capital gains tax, or at least deferring that. So the conversation get really organic. I think for your listeners, I fully believe for every buyer out there, like every buyer has their own demographic, right? Your own quirks, your own skill set, your own whatever. There's a seller that matches every buyer in the marketplace. And it's your job to have enough conversations to meet that property owner. And if you're the first time buyer, you're going to find that seller who someone invested in them by selling them real estate on seller financing at terms that maybe didn't seem like they were market terms, but they made sense at the time for that seller and that buyer. And it's just a matter of finding that person that you click with, you build that rapport with.
Yeah. And with this particular property, you got the seller financing. You mentioned that there was some deferred maintenance and some upside. So what was your game plan going in? Were you looking at doing some heavy lifting, then doing a refi at some point? How'd you structure that?
Yeah, no, that's a good question. I don't know that we really had an exit strategy in mind. It was hold it. So the way we set up the financing, and that kind of dictates some of it. So the way we set up the financing was, I think we started with like a 3% interest rate for a 3 or 5 year period of time. And then we had a 3-year window of time where the interest rate went up a third of a point for 3 years. And then after 8 years, then we were going to go to a like a LIBOR schedule, some type of schedule like that. And so we kind of looked at it as like a 5 to 8 year play. We'll reposition it, we'll fix the deferred maintenance, and we'll sell it in between that period of time. And kind of the fun thing about this, so when we agreed with the seller financing terms, it was a $10,000 down payment. So that was our focus, right? So that's, we were going to have to pay 10 to the bird dog, we have to pay 10 to the seller, and then we'd have some money to fix it up. Our plan was to fix it up over a period of time. And then, like most rentals that are occupied, you negotiate ever before seeing the property, which we always like to do that. So when we actually saw the property and saw what the deferred maintenance wasn't even deferred maintenance. It was just basic level living standards. And so because of the condition of just the living standards and the amount of money we had to put into it just to make it a habitable space, what we renegotiated was we changed the down payment from $10,000 to $2,000 with a commitment that we would invest that $8,000 over the first 3 months of ownership. And so just restructuring the deal a little bit like that actually gave us our renovation money, and we did things like mold abatement, a couple plumbing leaks, sealed up some things. And then we really just kind of kept those tenants in there so we sold it in 2015. In 2015, we had to evict one of the tenants. We renovated that unit. Market was changing for multifamily in Portland. And at that time, that's when we put it on the market to sell it.
Gotcha.
Yeah.
Yeah. And so you've sold the property. What was your return? Do you have those numbers off the top of your head?
Yeah. So we paid $250 for the property. We put about 10 grand into it in the first 6 months of ownership. When we renovated the one unit that vacated, we put another 12 into it at that point. So 272 is what we're into it-ish, roughly in that ballpark. And then we sold it for 390. So, good 6-figure profit. But more importantly, we only used 12 grand to close, 10 grand to fix it up initially, which we all got back in that first 3 years. So the cash on cash numbers were pretty ridiculous on that.
Yeah.
But the real value of that deal was when we went to sell it, it was, we just called the seller we had a relationship with, right? So we send really nice Christmas packages out every single year to all of our previous sellers. Like nice bottle of wine, nice bag of chocolates, nice bag of coffee. And so when it's time to sell it, we just called them up and said, hey, we need to put this property on the market. It's just time. It's not fitting. It doesn't fit our portfolio. It's kind of like the redheaded stepchild. But we have a couple other acquisitions in the pipeline. How would you feel about continuing lending to us? Yeah. So it wasn't the first time we've walked the mortgage. I didn't know that term at that time. Substitution of the collateral was a tool that when the seller's right or the property's right, we've set that up in advance on the initial acquisition negotiation. On this one, we hadn't, because we didn't envision that ever coming up. But again, had that conversation. Yes, he doesn't want the capital gains. And so when we sold that property, we just recollateralized him and used his cash. So then we bought another triplex in Oregon City, and that acquisition I think was 220, 225. We owed him like 245. So, and it's same exact conversation with him is, here's the renovation plan. Here's what we'll spend in the first 6 months. And he was happy with that. I think he wanted us to pay the principal down $5,000 at closing. So we paid the principal down $5,000. Then we ended up getting like a $20,000 check at the acquisition table on the next triplex, which was then the money to put into that project. So that was the first time that we'd walked the mortgage after, when that wasn't ever a plan, right? We had that conversation later on, and now we're implementing that into our seller financing, where seller financing can be pretty intricate the way you negotiate it. And if you try and ask for too many moving pieces up front, it can get complicated and turn people off. So we just take a different incremental approach now because of our experience with this lender.
Yeah, no, and I'm really glad you brought up that example, because I think it shows people the how you can really move the pieces around and
Yeah.
really put it to work for you. That's great.
Yeah, and then when you compound that, so again, $2,000 got us into that deal. It was 12 because we had to pay the bird dog, but if we didn't pay them, $2,000 to get into the deal, made over 6 figures off of it, and then the triplex in Oregon City, we made over 6 figures off that as well. So, and you can borrow 10, 20 grand pretty easily.
Yeah.
So that's why it was a springboard for us. Is just anyone can do that deal. Anyone can change their life from a transaction like that.
Yeah, that's great. And speaking of how you can change your life, how has your life changed since you got involved in the real estate investing?
Wow. That is a great question. And I just say my life's a little bit more even keeled, I think, is the answer to that. When I first got into it's the emotional real estate roller coaster, right? Even when I was an appraiser, I was on these emotional highs and lows, and through time, those peaks don't get as high, those lows don't get as low. So my life is much more calm. Obviously, when you have a lot of passive income coming in, that helps. I mean, that takes the edge off life. I mean, money's not going to make you happy. It makes life easier, and I think we're idiots to ignore that. Right now I'm working on becoming 100%er, is what they call it in GoBundance, where passive income's 100% of your personal expenses. Not there yet, but close enough to the point where I'm not stressed out on a day-to-day scenario. I have fewer arguments with my kids because of it. So, obviously the financial freedom changes a lot from your stress level. But I think what's really grown. So I remember back in 2009, when I made the transition, I actually did Rich Dad Poor Dad. I spent 26 grand on one of their packages, and in that 3-day weekend where they sell you on all that stuff, I was on an emotional high there. I came back to my wife and I was like, I want to be a motivational speaker. That was a goal that I had put out in October of 2009. And through real estate now, I have kind of become that, right? So with our Rarebird Investor Network platform, we just kind of give away all of our tools, free education. And now I've seen other people become millionaires, and seen how just investing in them has changed their lives. And again, ultimately, what are we doing this for? Money isn't going to buy everything, but when you can create a tribe of people that you really see eye to eye with, have similar skill sets to, have similar life philosophies, and you can lead them to living passive income lifestyles, well, that just makes your life great, because your friends are they're competitors, but they're friends at the same time. So yeah. I think that's a long way to answer that question.
No, that was a good answer, though. That was a really good answer. So where can people find you, Mike, if they're looking to learn more about what you're doing and your different businesses?
Yeah. So because we have different businesses, we have a lot of different websites. I'd say if you want to find out about our investor community, that's kind of the coolest thing we're doing for other people right now. That's rarebirdinvestors.com. We have a local RIA chapter in Portland. It's kind of like a guru machine. It's a stop on the map. Our community is completely different from that. We only have local people talking about what works locally. So it's a different mindset, different type of community. I think if you're interested in what we do, that's a great place to start to find out about us.
Oh, that sounds good. Well, Mike, just want to say thanks so much for taking the time to share your success with us today. This was great.
My pleasure, Seth. Thank you for having me. I appreciate it.
You're very welcome. And to you, our viewers, I wish you well in your journey from purchase to profits. See you next time.